I mean, these were the plans 20 and 30 years vaporized because someone sneezed the wrong way on Wall Street. And something didn't feel right about that. I was kind of brought up in the traditional financial model.
Welcome to the Real Estate Marathon Podcast, your guide in the race to financial freedom through real estate investing and sound financial practices. This podcast is for anyone interested in learning more about real estate investing, personal finances, and a new take on traditional retirement. Now, here are your hosts, Larry Fierro and Mike Moe.
What's going on, everybody? Welcome to the Real Estate Marathon Podcast, your guide on this journey, on this race, on this marathon to financial freedom using real estate investing and sound financial practices. It is a marathon, isn't it, Mr. Fierro?
It is, man. Whenever we talk about the marathon, the financial information, I get a little, our financial freedom, did I say information?
You did say information. I'll give you a pass because I knew you meant independence.
I did.
So.
But whenever we say financial independence and marathon, I just get a little teary-eyed because it's just such a beautiful thing. And it affords people so much freedom. I've been back for 4 days since the Labor Day camping trip. And I go out Saturday again on another week-long camping trip. And
Dude, you could have all the money in the world, but if you're not financially independent, it's like those people who make like millions of dollars a year, but spend millions of dollars a year. They're still chained to those jobs. The beauty of this is being able to do what you want, with you want, when you want to do it, right? So it's taking complete control over your most precious resource, which is your time. So it's such an important journey, and it's fantastic that we get to help people kind of along this path. And, you have having made it there and myself on that journey, it's a fantastic thing.
Yeah, dude. And it's easy to get to the point where you're knocking on the door to it. I'm telling you. And the hard part is actually pulling that trigger to get rid of the full-time job, that weekly paycheck. Remember, that's what I was struggling with.
Oh yeah.
I was struggling so hard with that. And then, one thing led to another, and boom, here I am. I've been 5 months now? 5 months on it, not really unemployed, but
full-time podcaster, full-time real estate investor.
Yeah. Full-time camper, man.
Yeah, right. That's more like it.
And I'm not just talking on Call of Duty. That's for you gamers out there. So I've got the warm-up here. You want me to jump right into that?
No, man. Before we gotta prep the folks before we go into this warm up.
Oh, I'm just so excited for the warm up, bro.
You're excited. We're talking about the race. We're talking about the marathon. You're excited to get started, but we got to know who we're running it with. So this leg of the marathon is brought to you by Mr. Mark Willis. As we talk about a new take, we're talking about banking on yourself with Mr. Mark Willis. Now, Mark is a certified financial planner and two-time best-selling author, and he graduated from school, ton of debt, and decided to kind of look at the financial planning industry a little different than the traditional financial planners, and because of that, he's got some unique aspects to share, and we're going to dive into them, the bank on yourself concept. So,
yeah, and. Dude, when we first started interviewing, I was kind of suspect a little bit. I'll be honest with you. I'm kind of a pessimist, not really a pessimist, but I like to dig into things and find out how things can go wrong. I was really impressed with this plan because the way they structure it and everything, it helps you accelerate your financing. And you guys will hear about it shortly, but it accelerates your retirement income. And, the one thing that impressed me was he came across and said, a lot of the people are 50 and over that are starting these plans. And one gentleman had one that he started. It had like $100,000. I think he set in $50,000. And 5 years later, he was well over 200,000. I don't remember the exact number, but in 5 years, he put on, no, it was 400,000 in 5 years.
Yeah.
And that's just impressive numbers. I don't care who you are. If you can make $500,000 or $400,000 in 5 years, you need to look into it and start paying attention.
Yeah, I'm a little bit of a skeptic as well. So you could tell by the questions I was asking them about, like the fees associated with this and all the, all what's the downside, right? I'm super interested in this concept as well.
Yeah.
Because we talk about a lot of people think buying, certain things with cash is a really, really good idea, right? So coming up, I'm in a position where we need new cars for my wife and I, right? So I'm thinking we should just pay cash for those instead of take out a loan, right? That'd be the best thing to do. But as we talked about with Mr. Mark Willis, you can essentially pay cash for that, but still have, if you use this, the bank on yourself concept, you can still have that, essentially that cash continue to make returns by leaving it in this product that he offers. So
yeah, and like I was going to say, you were asking all the questions because it's our job to delve into these things for the listeners. We don't want to lead the listeners astray, and that's why we're kind of acting as their representative in the podcast, asking the tough questions that need to be asked.
That, and I'm selfishly looking into this, so I want to know everything about it for myself. It's just a bonus that our listeners get to tag onto that.
Well, there you go. All right, so I'm excited for this warm up. I'm going to stretch my hamstrings and read this if we're ready now.
Let's do it.
Okay. Whole life policy. A whole life insurance provides coverage for the life of the insured. In addition to paying a death benefit, whole life insurance also contains a savings component in which cash value may accumulate. These policies are also known as permanent or traditional life insurance.
Yeah, and we're going to talk all about how you get to use these policies in a non-traditional way. Typically, I've always looked at some of these insurance policies, whole life insurance and things like that, as not typically the best use of your funds. But we're going to explain how you can use it in a new way, and it's going to be fantastic. So,
and I love the fact that you have to find a bank on yourself expert. And they'll set that up for you. So
and I mean, everybody's got to do their own due diligence. This is definitely, it's definitely a product to be sold. But if you use it right, and if it's a good fit for you, it can definitely get you ahead a lot quicker than maybe just shoving some of these funds in a bank account somewhere.
That's it. So I'm excited to jump into the interview with Mark Willis. So if you're all good to go, let's jump in.
Do it, man.
All right, Mark Willis, welcome to the Real Estate Marathon podcast, man. How are you doing?
Oh, thanks, guys. Doing well. How are you?
Fantastic. Yeah.
Doing really good. Thanks for coming in.
Thank you.
Yeah, looking forward to this, man. We've dug into your story, and we're super excited to talk about this concept that you got around banking on yourself. So, but before we dive into that, can you give the listeners a background on who you are, what you're doing, and kind of how you got into this?
Well, I'm not your average financial planner, that's for sure. I didn't get a degree in finance. I graduated actually with 2 private school degrees plus one from my wife with $120,000 in student loan debt. So Mike, I know that reverberates in your story a little bit, but we started life with 3 degrees between us in 2008 when the markets were crashing, real estate was crashing, job losses. Nobody really wanted to hire us with our kind of non-employable degrees. So we were just starting life well, guys. I'm telling you.
It's a good time to get out there, huh?
2008 was a rough year.
Yeah. Oh man. Yeah. So we got our feet kicked out from under us before we even really got on our own 2 feet. And we really were looking for a solution. And all we found was kind of some radio hosts telling us to do the snowball method to pay off our debt. So we followed their advice, really didn't question it and just kind of went after it. I got really focused on my own personal finances as a result of this, let's just call it a kick in the pants, to get going. So I got really interested in finance. I got really interested in our money, our budget, making income, reducing expenses, living on beans and rice. And on the weekends, guys, we had rice and beans. So it was super special on the weekends.
Sounds like the Dave Ramsey special right there.
Yeah, exactly. That's right. Yeah,
nice.
Exactly. So we got to about halfway through our big project of paying off all that debt when we finally realized that we had done something terribly wrong. In fact, I've even said it was the biggest mistake of my life was paying off my debt the old-fashioned way. So we can get into that if you'd like for today's episode, but it relates to the strategies we now use with our financial firm, Lake Growth Financial Services.
Yeah, let's get into that a little bit.
Sure. Yeah. Well, it was sort of a strategy that we were introduced to. A mentor of ours sat me down and kind of introduced me to some concepts and strategies I'd never heard of before. It was also in the midst of, just to give a bit of context, I was starting to work with a CPA and was doing mostly tax prep for this CPA at the time. And I was mostly doing those tax returns and everything, but the CPA would also do investments and investment planning, 401k, IRA management. And I distinctly remember in 2009 and 10 when I was working with her, she was way better at investment planning and strategies than most I had ever seen. I mean, just nationally recognized. But I remember her having calls with clients. Some of them were 62, 63 years old, saying to them, I'm sorry, Mr. Client, but I just lost you half of your life savings in the markets, and you can't retire like we thought you could. I mean, these were the plans, 20 and 30 years vaporized because someone sneezed the wrong way on Wall Street. And something didn't feel right about that. I was kind of brought up in the traditional financial model. I had been trained by her. And then as I was going through my CFP training to become a certified financial planner, you're really kind of given the blue pill, so to speak, to stay in the matrix and kind of taught the party line when it comes to traditional financial planning. And that's good. It's certainly been the mainstay of financial advice for decades and generations, but really not that long. I mean, even as far back as the early 60s, we were doing something as a nation very different than what we do today. In fact, I was reading a book. It was Happy Birthday 401k or something like that. It was the guy who created the 401k, Ted Benna. He just came out with a book. This year is the 40th anniversary of the 401k. 40 years. 40 years.
Yeah.
So I'm being taught that the 401k was created on the sixth day of creation, but it's not that long ago that 401ks were created. In fact, I met a guy who actually got the 401k the same year it became possible to have one, and he was still working. He had not retired yet. Now that should tell us something, right? The 401k is not an absolute sure shot at financial independence and success. So for all of this, I was I kind of look at those first years in financial planning like being dropped into the front lines of a war. I'm excited about being a financial planner. I'm wanting to get into finance. I'm wanting to get my own financial house in order. And I'm watching as I'm being dropped into the front lines of the 2008, 9, and 10 meltdown, watching all these people lose their shirt and their hat in the markets, and their 401ks becoming 201ks and that sort of thing. And I was really just asking myself, is this really the best we can do? Why do I want to build my career on a house of cards? So, for a time, I even thought about not continuing in the industry. And it wasn't until I found some strategies and a mentor of ours came by and visited us. He was a former professor from college, didn't really have a horse in the race, just wanted to share some ideas with us that he had found. And I think he felt sorry for my wife and I because he saw how hard we were working trying to pay off all of our student loan debt. And he was a professor that kind of, was at least accomplice in helping us gather all that debt. So,
nice.
So that's where he dropped the bank on yourself bomb. And so I'll hush for a minute. What questions, feedback on that so far?
The couple things I really want to unpack in there is the fact that you started down the party line, if you will, and you took the blue pill. And what exactly was it that made you take the red pill? What was your red pill moment, your aha moment, your matrix moment, Mike likes to call it? And, was it the fact of your student debt, or what exactly got you into the fact that you wanted to get out of that system?
Well, it was a combination of factors. One, I knew I was not in control of my financial life. The banks were, and Sally Mae was, and all of the student loan debt that we accumulated, and the fact that we had no liquid cash reserve. If we had a flat tire, we were going to go farther down the debt hole if we just had, a simple emergency, health, medical, loss of job, that sort of stuff just happens. The longer you live, the more you realize that's not a if emergency, it's a when, and it's multiple times, usually over your lifetime. You have to be out of work for a pandemic, let's say, just out of, just random, drawing that idea out of my hat here. So,
wow.
So you really begin to sort of realize that banks, when they control where your money lives, they win. but when you control where your money lives, you win. And I started to realize that paying my debt off with cash was not the answer. That Dave Ramsey, it was the question, here was the matrix moment, Larry, to answer your question. It was when my professor and friend and mentor said, Mark, is it possible that Dave Ramsey could be wrong about something?
Not Dave Ramsey.
Just a question.
Never.
Yeah.
Not Dave.
Yeah. I mean, didn't he write the fifth gospel? So he was absolutely right. I had not thought critically about what I've been hearing on a radio show and not really thinking about what the problem was, what the cost of debt payoff was. Now, let me explain. I now believe that you finance everything you buy. Everything you buy is financed. Either you use another bank and you pay interest to that bank, or you pay cash for something, car, vacation, real estate. You pay cash for that thing and you lose the opportunity to earn that money ever again. You'll never see interest grow on $1 you spent on the cup of coffee this morning ever again. So I learned that either you pay interest to a bank or you pass up interest if you pay cash and don't keep it invested instead. And that truth, that opportunity cost was what my matrix moment was. I realized that all that debt, I'd thrown close to 60, 70 grand at my debt, and all I had to show for it was a bunch of thank you notes. Thank you for your payment. Yeah. Thank you for your payment. So what could 60 grand have grown to by now or by age 65? So that was sort of our matrix moment. We realized that the banks held all the cards, that they were in control, and we were just flying into a headwind that we could never overcome.
And was that right around the time that the professor, who was a culpable in your situation, came to you with the bank on yourself plan? Yes.
Yeah. So among another 400 plus financial vehicles that I was studying and learning about, real estate, dynastic trusts, 401ks, annuities, all of it. You're presented with all these different products as you go through your licenses and kind of learning about the financial universe. And I was eating it up. I loved the whole thing. It took me 3 years, but I loved every minute of getting that CFP credential. But one of the things that really caught my attention, and it was what my professor and friend brought to us, was a very arcane, old-fashioned sounding financial vehicle that let us buy back our debt and become better than debt-free. And he called it Bank on Yourself. And guys, what it is, it's a little-known variation on a whole life insurance contract of all things. So, I started to think, well, first of all, Dave Ramsey would be, screaming in protest if he was in this living room with me and my professor. But then he asked that question about, could Dave Ramsey be wrong? So that started me on a 7-month quest, really, to see, is this thing real or not? Is my buddy, my professor, in some sort of scam that I need to break him free from? And really, it really caught my attention. So give me maybe 3 or 4 minutes. I'll try to keep it as low down the ladder as possible for all of us. But it really represents 4 things. And it starts with a point that where you keep your money makes it act different. That sounds so obvious, but if you think about that for a minute, like how many of us spend even 5 minutes of our life asking, what do I want my money to do for me? If I'm putting my money in all these different buckets, brokerage accounts, money market accounts, a shoebox, everywhere you keep your money makes it act different in the way of taxes and risk and predictability and creditor protection. So I started thinking, all right, what do I want my money to do for me? And this specific type of whole life insurance did all the things that my wife and I were looking for. And so I'll kind of explain 4 features and then I'll hush and we can chat more about it if you'd like. So I have a little funny acronym to keep it easy. It's TGIF. TGIF. First is there were tax advantages I had never seen with anything else in the financial universe. You can put the money in after tax like a Roth IRA. It grows tax deferred for your entire life, and you can access both the principal and the gains without taxes due, just like a Roth IRA. But unlike a Roth IRA, there's no government restrictions, there's no contribution limits, and there's no income phase out. like there are with Roth IRAs. Most people listening to this podcast, I'm sure, earn too much to contribute to a Roth IRA. Or if you don't yet, you might soon. And so you love the idea. Most of my clients love the idea of tax-free income in retirement. But most of the time, Roth IRAs are unavailable to the savviest investors. But this is a whole life contract that has many of the same characteristics and tax-free nature as Roth IRAs do. In fact, fun fact, Alan Roth, or Mr. Roth, Senator Roth, who kind of wrote the rules around Roth IRAs, did that as he was investigating and looking into getting a life insurance policy on himself back in the 90s.
Nice.
So the first piece is tax-free, tax advantages, and really even the availability for it to be tax-free in retirement. So that's the T. G, its growth is guaranteed and locked in. So whole life insurance grows on a guaranteed schedule, and there's nothing we can do to stop it. The life insurance contract with the insurance company, if it's a truly well-run, mutually held life insurance company, has a contract that shows a schedule of you having more cash this year than you had last year. And for the rest of your life, you have guarantees and gains built in. On top of those guarantees, they'll throw dividends if the company's profitable. And I usually only work for our clients. I only work with insurance companies that have been profitable on top of that guarantee, like icing on the guarantee cake, for at least a century without fail. Like I want them have gone through 2008 and paid dividends. I want them going through 1987 paying dividends. I want them even in the Great Depression paying dividends. Heck, I want them to be paying dividends back when we had our last global pandemic in 1918, right? So that's the second piece, is guaranteed growth. Maybe I'll hush for a minute. Any thoughts so far, guys, or feedback?
No, I think that's great, man. Let's keep going on the TGIF, and then I think we got a few things to unpack for sure.
Sure. Okay. So third one is fairly obvious, although it needs to be stated. It is insurance. I is insurance. So, with insurance, what can I do? I put $1,000 in my savings account. I die tomorrow. What's my family get? Like my family gets $1,000. If I put $1,000 in my real estate and I die tomorrow, what do they get? Well, they get $1,000 of equity, right? If I put $1,000 in my life insurance policy, depending on my age and health, I'm going to leave my family more than I'll save for them, automatically and guaranteed. And also the death benefit is income tax-free as well. So that's incredible. So whether you're just starting out in life and only got a few dollars to your name, or you've got a net worth of $50 million or more, you can benefit from increasing your estate without having to increase the risk, because these are, again, life insurance contracts with guarantees. So that's pretty amazing. And it shouldn't be overstated. Even though we really shrink down the expenses, the death benefit, and the commissions to design the bank on yourself policies for cash value, cash is the part of the policy you can use and spend on this side of heaven, which it's way more fun to spend money on this side of heaven,
Absolutely.
in my opinion. There is a death benefit, and we shouldn't overlook that. The fourth and final piece, the F, is financing. And this is the game changer for a lot of our real estate friends, and myself included. When I use my policy, and I can use the policy on this side of heaven in two ways. One, I can make withdrawals, just walk away from the policy and withdraw all the cash value out of the policy. Or I can use my life insurance as collateral for a life insurance policy loan. So I can borrow against my policy's cash value. The insurance company gives me the first right to my own money in my policy. I can borrow against it, and that policy will continue to grow even on the capital I borrowed, as if I had not taken the loan, which is unbelievable, jaw-dropping, amazing.
That is. That's impressive.
Yeah, go ahead.
So you're cutting out that opportunity cost that you talked about, right? Like if I got 30, if I want to go buy a car cash because that's what Mr. Ramsey says to do, and I shouldn't take out debt, I go throw $30,000 down on a car, I can now not receive dividends or interest or any sort of investments off that 30 grand because it's done, right? Granted, I'm not paying interest, but in this case, you're taking that out, right? Because you're taking the cash out of your policy. It's still growing. You're still getting your benefits out of that, but you're able to buy that car without paying interest to the bank. Am I following that right? Okay.
Yeah. So the policy will grow even on the capital we borrow, as if there is no loan. And meanwhile, the loan you have on the policy is non-recourse, which means there's no required repayment plan. You control the repayment to your own policy or not. If you don't want to pay that loan off, as long as the policy is in force, when you pass away, let's say I did this yesterday, Mike, and then I pass away today, my family's going to get my entire death benefit minus the 30 grand to your example. So if I've got $1 million death benefit, they're going to have to scrape by on $970,000.
That's cool. Yeah. Plus car. Yeah.
So what I'd like to unpack a little bit on that is when you take the loan out and you choose a repayment schedule, can it be set up to pay interest to yourself so that'll increase the value of the cash value?
I would hope so, right? Yeah. If I'm going to bank on myself, I don't want to be I don't want to steal from my own bank. I better pay myself an interest rate if I can, right?
Okay. I just wanted to make sure that I'm understanding that right. So you're borrowing from yourself, you're not losing the opportunity cost, and you're paying yourself interest. So it's a win-win-win.
That's right. Yeah. And there's all sorts of ways to do all of what you just said internally and logistically, Larry. But the basic core function is we're acting like a banker. We're reclaiming the banking function in our life. Now, think about it this way. We're already in the banking business. We're just sitting on the wrong side of the banker's desk. The banker has all the cards. He or she decides whether I'm getting that loan today and what's the interest rate going to be and what's my monthly payment going to be. They decide all of that. But when you are the banker, when you're banking on yourself, you decide everything there. How much do you want? When do you want it? Do you want to repay this loan over 5 months or 5 years? Do you want to just wait until let's say we bought a house with our policy, paid cash for our house, but we're using a policy loan. So we look like a cash buyer for this real estate deal. And let's say we're into flipping houses. I know you guys do a lot of multifamily, but let's say there's a simple example here. Let's say we're going to flip a house real quick. So we borrow out 50 grand to buy our house. All right. The policy continues to grow and compound like we never took the loan. Let's say it took us 12 months to fix up the house and then sell it. We don't have to set up a repayment plan for 12 months. So nobody's calling you at dinner time. Nobody's wrecking your credit score. It's your cash. And then when you finally do sell your house, the flipped house at a profit, you repay all the policy loan back into the policy. So it's ready to go again for the next house that you might want to flip. And you've got your profits from the flip of the house too.
And if you choose to dump all the profits back into the policy, can you also do that? Say you make 50 grand on top of it. Can you put 100 grand right into the policy to have for future flips?
Yes is the short answer. As long as the policy was engineered to hold those extra dollars, and every policy should be engineered by a bank on yourself professional. There's 10,000 life insurance agents out there. Not all of them. In fact, most of them have no clue this even exists, which is a shame, but that's okay. I get it. They're there to sell a certain company's products or whatever. So you really want to make sure that whoever engineered this for you from the start was a bank on yourself professional, because they will be able to make sure that there's that wiggle room, Larry, to add additional monies when you have those proceeds, the profits from your business or other things, if you get a Christmas bonus from your day job or whatever else. Yeah.
And the reason I was asking that, because I know a lot of retirement accounts, IRAs and 401ks, they limit how much you can deposit in a year. And this just sounds like the sky's the limit.
That's right. Yeah. As long as the insurance company will approve us, you can have as many policies as you want, and you can put in as much as you want into the policy as long as you were approved for the life insurance. Here's what I mean. Life insurance companies will never over-insure us. A lot of people say, well, I've got too much insurance or I don't need any more insurance. I can promise you that underwriters at insurance companies are very good at not over-insuring anybody. Take our cars, for example. If I have a car worth $3,000, a small old 1990 something car, they can't give me an auto insurance policy for a new Tesla if I wreck that car, right? Mm-hmm. They're only going to insure the car for what it's worth. Same with all of our lives. I know that sounds a little weird, but underwriters give us a number. They all see this number floating above our heads, and that's the total amount of life insurance they'll give us. So that's the cap on our life, and that's how much packing in that money It's all about how little death benefit can we squeeze and get by with. That's where the expenses are, and that's where the limits are from the insurance company. But if we can squeeze that death benefit down real hard, get the commissions out, get the expenses out, let the policyholder, the client, keep more of their cash value, then we can throw hundreds of thousands of dollars, if you wanted to, a year into one of these policies or multiple policies.
That's awesome. Cool. So I do want to get into kind of some of the structure and some of the fees that might be associated with it in a second. But before we do that, I kind of want to take a step back, break it down for some people who might be hearing about this for the first time. It's kind of like when you were challenging the Dave Ramsey for the first time, you're challenging what is the norm, right? With something that seems really too good to be true. So I want to be cognizant of where some of our listeners might be in that aspect. So, so it's going to take a little bit of research. It's going to take a little bit of education to get to the point where people feel comfortable with this. But essentially, you're using a product like a whole life insurance policy and being able to use it in a way that hasn't been done before, right? So what are some of the first steps that somebody can do if they're interested in doing this? Is there particular person or stage in life or persona that fits this mold, or is it available for everybody?
Yeah, sure. Yeah. And I would say, again, not all whole life insurance is designed this way. And so Dave Ramsey is right about 90+% of whole life insurance out there is the way he describes it. It's laden with commissions in the first year. There's no cash value in the first few years. The death benefit doesn't grow, so it doesn't keep up with inflation. That is the truth about old-fashioned whole life. But what's interesting is if you find the secret life of life insurance as fascinating as a nerd like me does, it's been around for 200 years in this country alone, and further if you go to other countries. Something's right about something that's lasted that long, right? Yeah. So do your own homework, do your own research, but all of our grandparents very likely had this in their portfolio. In fact, in the 1940s, half of all Americans kept the majority, over 50% of their savings in insurance contracts. Where did we all put our money before the 401k, right? If something is an experiment, if something is shaky and untested and unproven, it's the 401k. It's not
40
even
years, right?
Yeah, it's not even old enough to retire on its own cash yet. So, I would say do your own due diligence. Don't do this just because you heard it on a podcast, even one as cool as Real Estate Marathon, because you really want to make sure this is a good fit for you. It certainly is a saving strategy. So you got to pack money away in something, right? Don't do this if you can't save. If you're unable to stand the moderate to middle single digit returns, it's going to bore you to tears if you need 30% rate of return every year, right? Because these policies are they're not an investment. They're a savings vehicle. They're meant to be
that you could use for an investment though, right? So you can get those say quote unquote boring returns and then use that to get your whatever your target return is for real estate or whatever thing you're doing, right?
Yeah, Mike, you're exactly right.
And you're actually getting double benefit because you're still getting the interest, the nominal interest on the money that you've already employed. So you're actually deploying this money twice.
Yeah, exactly. And if we have time and if you feel like it'd be helpful, I could actually talk through a compare contrast with just paying cash for a house versus using the policy to do the same thing, if we have time for it. Sure, but yes, you can get that arbitrage is the fancy word there, Larry. But you can increase your yield without any additional market risk using the policy. But yeah, you don't want to see unmet expectations, I think, is a big reason why people have to say no to these policies. If you have an expectation that this thing is going to keep up with the best years of the stock market, you'll be disappointed. So
can we talk a little bit about some of the more nitty-gritty details around these? So from an expense standpoint, are there any limitations to some other the retirement plans as far as age requirements on having to pull things out? For the terms and the rules that people are used to with traditional retirement accounts, do any of those apply?
Well, good. Okay. So this is different than what Dave Ramsey talks about. The death benefit does grow and keep up with inflation. The cash value is about 8 to 40 times more cash than the old-fashioned stuff. The commissions are cut by about 50 to 70%. which is probably why your insurance agent hasn't told you about this, to be very honest with you and frank with you about that. The nitty-gritty details, there's no credit checks to get the loans. When it comes time to getting a loan, you can usually access that loan within about 5 business days. So, hey, I want $100,000. Earlier this year, guys, I took a loan from one of my policies for my tax payment and had my money in my bank account in just a few business days, like 2 or 3 days. It was amazing. As far as other things, there's no required minimum distributions like there are with 401ks and IRAs. You're not forced to take the money out. There's no penalty for accessing the money too soon. So if you're 39 and a half instead of 59 and a half, right? There's no penalty to get the money out. It's your cash. It's also a private transaction. So the insurance company doesn't report this to the credit bureaus or the government. It's a private transaction. When you request a loan or a withdrawal from your policy, it's between you and the insurance company. And in most states, and I'll hush on this, but there's more we could do, of course, but in most states, the insurance company protects the policyholder in the event of a lawsuit or a bankruptcy. So your cash value, the money that's yours, your net worth, is shielded from creditors and predators, which is a good thing if you're in real estate, especially.
For sure. Yeah.
Now, I'm hearing that there might be a bigger benefit to getting one of these accounts early on. Like Mike is a little bit, he's quite a bit younger than I am. He's quite a bit younger. I'm almost 50. Is there a policy benefit of getting it at my age versus 30? And at 50, is it already too late for me to employ one of these or deploy one of these methods?
Well, you're right, man. Larry, we all could have had our parents set one of these up for us when we were born, but that's okay. No, my average client is actually over age 50 in terms of their age when they get started.
Oh.
And happens to be that the way we structure these policies, think of a seesaw a little bit. So you can either squeeze down the cash value like old-fashioned whole life and have a big death benefit. And then in that case, yes, the older we are, the more expensive that death benefit is. So, a 60-year-old buying $1 million death benefit will have more premium. That's the money we contribute to the policy. It'll cost more for a 60-year-old to buy $1 million death benefit than a 6-year-old to buy that same $1 million death benefit. That seems to ring true to most people, just like term insurance, right?
Yep.
But the way we structure it, flip the script, flip that seesaw on the other side. We're cutting down the death benefit. You might only need to get not $1 million death benefit, but maybe $400,000. But we're squeezing as much premium as possible. And the cash value of a 60-year-old or 50 or 39 or any other age will be the same relatively as someone who's much younger. Now, so age is less of an issue when we're doing this for bank on yourself type designs. Okay. One thing I will say though, let's say that you've had some major health issues. Like I had a gentleman who he loved this concept, but he had just had open heart surgery like earlier that year. And he could not get life insurance. Didn't matter how many candles were on his birthday cake. They just don't take people if they've just had open heart surgery. But he loved the concept. So what we did, he's a grandpa, so he got a policy on his wife, all of his adult children, and all of his grandchildren. He's got over a dozen policies now. And he loves the concept so much, he owns all 12 policies, and he controls the cash on all these policies. He uses that cash for investing and other deals. And he is the beneficiary of the policy if he should pass away before if they should pass away before him. Now, his outlook on life is he's probably going to die before they will. So he's actually written the contingent owners, the backup owners is his wife and then all of his kids. So he's actually giving them these policies if he doesn't need to spend them in his lifetime. That's a way around the health issue. You can also own these policies on employees and business partners in your business. So you don't necessarily have to be the insured, but you can still own and control the cash in each of these policies.
It's awesome. Larry, you cannot open a policy on me. I'm not going to allow that.
I've got like 4 policies in mind right now because I've got kids and friends.
And then one for your co-host, right?
Yeah, my co-host. I got to take care of him if anything happens.
Yeah, Mike, you're going to have to sleep with one eye open now, man. Sorry about this.
Yeah.
He's going to be totally lost now.
Right. But yeah, bottom line is you don't have to be 29 years old or a spring chicken or something to start one of these. You can start one up and design it for cash value. Death benefit's kind of just the added bonus, and we try to keep that as small as we can.
Yeah.
Cool. I like it. Can people take existing, can they fund these with any sort of retirement, with some sort of rollover or anything like that?
Oh, yeah. Yeah, that's a good question. And it kind of gets to a question I have with a lot of clients. And so I'll answer your question, but first let me tell a quick story. All right. So let's pretend that we're like a farmer out in the Midwest somewhere or upstate New York, and we're wanting to get our, yes, sir. And we're wanting to get our day going. So we're getting our coffee and we hear a knock at the door, and it's open the door and it's an IRS guy. Well, okay, that's unexpected. You bring him in, you sit him down. You're as kind as you can to this guy. Yeah, unfortunate. You give him a cup of coffee and you're like, sir, what are you doing here? And he says, well, I'm here on behalf of the IRS, and we're going to give you one decision that you will have the right to decide how we will treat you the rest of your life. Are you ready for the decision? Here it comes. Do you want us to pay tax? You're Mr. Farmer. Do you want us to pay? Do you want to pay your taxes on the seed or the harvest? Do you want to pay tax on the seed or the harvest? And you think about it and you're like, well, obviously the seed. I want my taxes out of the way so I can have my harvest tax-free. Okay. And then the IRS guy says, well, that's funny. Why would you have it done any other way with your 401k or your IRA? Because that's exactly how all of our 401ks and IRAs are being taxed on the harvest, right? Yep. Most people I talk to think, no one's got the crystal ball, but most of our clients say that taxes are going to be higher in our retirement. Over our lifetime, this country's taxes are very likely going to go up, up, up. In fact, they already are. There's a scheduled day, January 1st, 2026, we're under 5 years now, where the taxes for all of us go back up. And they may go way up depending on how much debt we all have at that point as a country. So is there any math that makes sense where I should put off paying my taxes now for favor of paying taxes later? No, I can't think of any. Even if taxes are just 1% higher, it'd make more sense for us to pay our taxes today like a Roth IRA. Okay, Mike, to your question. No, you can't take a 401k and directly add inside of it a life insurance policy. It's actually one of the only things you cannot put in a 401k, which is very interesting to me. I'll leave that for another podcast as to why the government doesn't want. But it's also interesting that 401ks are not even used by congressmen and women, but they do have plenty of life insurance contracts and annuities. In fact, Ben Bernanke recently had a interview where he said the vast majority of his own personal net worth was in some life insurance and annuity contracts, which is, I think, very interesting.
It's telling.
But, yeah, it is telling. Now, I will say this. You cannot do a rollover to a life insurance policy. A lot of our clients, and this is their decision, right? But they can make the choice if they want to take money out of their 401k this year. If they've been impacted by the coronavirus, there's something called the CARES Act, which many people may have heard of. And in 2020 alone, this is the only time they're doing this. Congress is allowing, if you're an eligible impacted person, if you've been laid off, furloughed, whatever, by the coronavirus, you can take up to $100,000 out of your IRAs and 401ks without an early withdrawal penalty. And they'll let you spread your taxes out over a 3-year period. Nice. So that's a rare case. A lot of our clients are deciding to put that money into policies, and then they use their policy to pay the taxes due over the next 3 years. That's pretty cool.
It is.
So anyway, long answer to your question there, Mike, but
it's awesome. So we might be getting too much in the weeds, but is the fact that you can borrow against this and the steady growth for somebody who might not be borrowing against it, is that the main benefit to doing something like this, or other than like the TGIF that you talked about, right? But that's one of the biggest things, right? You can borrow against it and you can deploy that capital elsewhere, right?
Man, if I just had the T, I'd be pretty happy. Or even just the G, right? Guarantees. What else in my financial portfolio is guaranteed? The 401k, what's guaranteed about that? My home value, what's guaranteed about that? My real estate holdings, what's guaranteed about that? So if I just had one of those, but yeah, the financing is huge. Now here's the thing: if folks had one of these policies and it was just a place for the money to park, that'd probably be great and fine and probably help you. I call it swan money, your sleep well at night money. But if you just had like somewhere to have some of your cash where it was predictable and growing and where you owned and controlled the outcome before you even got started, that would be worth something. But I would say, I think there's probably two types of people that have these policies. Well, there's three, but there's two wrong ways and one right way, I think, to own one of these policies. One way is people have a belief that every last dollar should never be touched in these policies. We never should touch the cash. We should still pay cash for everything and, just have our policies sort of out there and never touch it ever again. I feel like that's the wrong way to go because we're not taking advantage of the opportunity cost savings and the uninterrupted growth of the policy. On the other side of the log, if you're falling off one side or the other side of the log is, well, man, I'm ripping all my money out of my policy every year. I'm never paying it back. I don't have a plan to pay it back. Eventually, that policy could lapse, and then you don't have the policy anymore. If you never pay that loan off, you can lose the policy. And there could be tax consequences if there's gains and you lapse the policy. So the middle way, I think the healthy way, is to correctly use this policy like a financial management tool. Don't use it to buy your cell phones every year, but maybe you use it to buy your big stuff, right? Your cars, or invest in multifamily, right? And then let the rent checks or the distribution checks repay that policy loan for you. So you can wash, rinse, repeat. You can recycle that money over and over again, give it back to Larry and Mike over and over again for more investments, and allow that policy to continue to grow, compound, and keep investing in your real estate at the same time.
Awesome.
I kind of want to hear the scenario that you talked about a little while ago about buying a house versus, in and outside of the account or the life insurance policy.
Sure. Okay. I'll give an example. I will throw a few numbers. I'll try to keep it super simple since I know we're talking. So guys, pull the car over if you're driving, but I'll try to keep this nice and simple. So let's say that you're a real estate investor and I want to keep everything super duper easy. We're going to get rid of a lot of things like tax deductions and rent check. Let's just talk about buying this single family home that is going to grow in the neighborhood at something boring like 3% a year. Okay. So let's say your house purchase is $350,000. Okay. And let's say you open up your policy, and I'm looking at one here for a guy. He had about $400,000 in cash value in his policy. And this is just a few years after starting it. So, again, these policies have massive cash value from day one. And he, just a few years in, this guy here had about $400,000 that he could borrow out. So remember, the house price was $350,000. Let's take a scenario where he did not have this policy and all he could do was withdraw money out of his savings account and pay cash for the house. All right. So we take out $350,000 out of a savings account and pay cash for this real estate deal. Let's say that it grows at 3% a year over 5 years. $350,000 grows in the neighborhood. Your Zillow price says that it's $405,000 after 5 years. So, with me on everything so far?
Yep.
No policy involved, no loan against a policy. We're just watching that house grow. So over 5 years, you earned a total of $55,000. Okay, that's fine, I guess. That's great. Still $55,000, we'll take it. But if you had that, like this gentleman did, $400,000 in a policy, you borrow out $350,000, you buy the house, you are a cash buyer in the eyes of the real estate transaction. At closing, you just write the check. Now you've got a loan against your policy, but you also have the house, and the house is going to grow and appreciate no matter how you buy it, right? So $350,000 still grows to $405,000. That's still $55,000. Now, what happens next is really interesting. Now, there is a loan interest on these policies. Now, the insurance company is not doing this for charity. They do charge loan interest when you borrow against the policy. But recall, this is a mutual life insurance company. That loan interest is a part of the profits that all of us, like a co-op, receive at the end of the year in the form of dividends. So I did the math here in preparation for the podcast. And if it took this guy 5 years to pay back that loan, that would be about $38,000 of loan interest that he would pay over 5 years, which is about 2% APR. So the loan interest was 2%. Not too bad.
Right? Not bad at all.
Not bad. Better than most mortgages these days. And he was in control of repaying it. He could have taken 15 years, but he chose 5. Okay. So that's still, though, that's $38,000. And Dave Ramsey is saying, pay interest on your own money. Why would you do that? So what was the policy doing at the same time? Over the same 5-year period, the policy, without him adding any premium to it, just on its own, it grew another $120,000.
In 5 years.
In 5 years. Yep, without him adding a penny to it in premium, just on its own. So take $120,000 plus the $55,000 of property growth, of appreciation on that real estate, and my calculator says $175,000. Between that or $55,000, which of those two numbers would you rather have?
I like
that. That's awesome.
I like that.
I like the higher one. Are you also adding in the additional, to your point, the co-op aspect of that, where I am essentially receiving a small peanut butter cut of that interest, right?
Yeah. And it's crunchy peanut butter, man. I'm telling you right now. So, in fact, some of these insurance companies this year in the Corona special that we're all going through raised their dividends, gave us more profits this year than they had last year nominally, right? They're very boring and conservative. I think it was like 5.1 to 5.2%, but that's still, it says something about the business model of life insurance companies that they can actually raise their dividends in such headwinds that we're all facing this year.
That's awesome. Cool, man. Love that example.
Ooh, cool.
That's a lot. It is.
Yeah. It's a big red pill, but I'll tell you, when you start thinking like a banker, let's get rid of whole life insurance. Let's get rid of all of it. When you think like a banker, you start to float different through your life. It becomes less of a headache. You don't have to work quite as hard. The average American spends a third of their income on debt financing, mortgages, student loans, car loans. If you could recapture half of that debt and run it through your own banking system, man, you're going to win. And you can maybe stop working as hard. Maybe, spend some more time with the kids and live a more sane life, which is what it's been for me and a lot of my clients.
Awesome. All right, Larry, anything, any other brain busters you got, man?
No, I was just, I was concerned about I call it the mildly advanced age of 50. So now that you answered that question, I think I just need to get the information where we can contact with you and sign up.
Sure, Larry. Yeah, you're a spring chicken, man. These insurance companies let you go all the way out to 120 on their tables. And I think
you got plenty of time, Larry. Plenty of time.
Yeah. And I think they'll even let us buy them up to age 85, 89, I think is their oldest that I've seen. So yeah, we're all on the growth curve as far as I'm concerned. So
nice.
Best way to reach out to us if you'd like to learn more is growmorewealth.com. That's our kind of landing page, get to know you page. Date us first if you want to by going to Not Your Average Financial Podcast. We got over 100 episodes on this strategy and similar strategies. And we talk more about how you can use this for real estate or paying your taxes or college funding for your kids. So that's Not Your Average Financial Podcast, and then growmorewealth.com.
And we'll throw links to that right in the show notes.
Thank you.
Yeah, that's awesome. Can you, if people want to dive in a little bit more deeper into this subject, are there other resources, books that you'd recommend, things like that? Obviously, Grow Your Wealth and your podcast is fantastic. Are there other industry standard resources that they could use to dig in?
Yeah, again, growmorewealth.com and Not Your Average Financial Podcast are great starters selfishly because, we've got tons of content out there. But I would say as far as books go, I'll give you two. The one is The Bank on Yourself Revolution, and the other is Financial Independence in the 21st Century. The first one is sort of like the user manual. I would say any question you have would be answered by Bank on Yourself Revolution. The second one's more like a textbook if you want to go a little deeper.
Awesome, man. Cool. Really appreciate it. I know we went a little bit long, but man, this is a meaty subject and some really powerful tools, man, that I just obviously are not very well known. It's not the norm. It's not widespread, but obviously you've laid out a handful of examples where people can really leverage this for their benefits. So really appreciate you coming on and detailing that for us.
Appreciate it.
Yeah. Thank you guys.
Thanks, Mark.
All right. That was Mr. Mark Willis talking about banking on yourself. And Mr. Fierro, I love this concept, man. It's a new way to look at things, and it's taking advantage of some, really good opportunities out there.
I was a little scared too because I'm almost 50, and I asked that question.
You are old.
I am. I'm feeling it, man. I'm feeling it. That's why I have to camp, because my actual marathon days are almost over. I asked him that question about, is there a point in time where it's no longer feasible? And he said that you could go up to 120 years old. And you can buy them up to 89. And most of the people that he does that buy them are 50 in the 50s. So that's just, I'm definitely looking into it as well.
Yeah, absolutely. It could definitely cut some years off your savings and your future plans. So
yep.
We're always looking for efficiencies, right?
That's it. So what are we going to do for a call to action, Mr. Mo?
Well, dude, we talked about, Mr. Willis recommended a couple of pieces of material for you all if you're thinking about diving into this concept a little bit more. And that's the Financial Independence in the 21st Century, which is by Dwayne Burnell. You can pick that up on the good old Amazon. And then Bank on Yourself Revolution by Pamela Yellen. So if you guys are thinking about jumping into this, think about diving in, that's your call to action. Do a little bit more research, jump into the concept. I'm not going to call it a straightforward concept because it's definitely a little bit confusing if you're not familiar with these products or kind of how it works. So familiarizing yourself with this, if you're thinking about taking another step into it, is definitely something that you'd want to do. I never invest in anything I don't understand, so I would make sure that you guys do a little bit of research.
Yeah, you have to understand the concept before you just willy-nilly invest. Like he said, you don't want to invest based on listening to a podcast, even though it is an awesome one like ours. And he did say that. I think he said a fantastic, phenomenal, awesome one. Oh, he might not have gone that far, but I am.
Yeah, there you go.
And, but yeah, you definitely look into it, and any tool that you can get in your tool belt to get to that retirement, that financial independence number, man, just work on it.
Yeah, absolutely. I mean, that's kind of what this whole thing is about. There's not a magic pill for any of this. It's a combination of these varying tools that you can use at, different situations, but educating yourself so you know when to pull out the hammer, when to pull out the screwdriver in your financial life is what this is all about. So yeah, definitely.
That's it. So, well, man, that's all I've got. I just wanted to let the folks know that I hope they have a fantastic week. Make sure you listen to this 2 or 3 times. Go back to listen to all the beginning episodes and check us out at realestatemarathonpodcast.com.
And don't forget to leave us a rating and review. We would love you for it. And we're still shooting out a couple copies of what was it? What book
Richest Man in Babylon.
Richest Man in Babylon. That's the one, and it's a fantastic read. So give us a rating and review over on iTunes and shoot us a screenshot of that, and we'll hook you up.
Just help us get the information out to everybody.
Heck yeah! So cool. All right, thank you guys for tuning in to another episode of the Real Estate Marathon Podcast. We'll see you next time.
Take care.
Thanks for listening to the Real Estate Marathon Podcast. If you found value in any of the content from this show, consider supporting us in the following ways. Subscribe to the Real Estate Marathon Podcast. Leave a rating and review. Continue the conversation with like-minded individuals on social media by heading over to the Real Estate Marathon Podcast Facebook group, or follow us on Instagram and Twitter at Real Estate Marathon Podcast.